What if I told you that you could make money on your crypto without ever hitting the sell button?
Sounds too good to be true.
Well, there's a legit way to squeeze dollars out of your stack, and no, it's not staking or praying for an airdrop. It's actually a method crypto whales use all of the time, and it's open to anyone who knows where to click. Today, we're going to tell you about this method, explain how it works, and walk you through the process step by step. My name is Louis, and if you want to make your crypto go the extra mile, stay tuned. First up, although we will be looking at the crypto markets today, I do need to make one thing clear, and that is that I am not a financial advisor, and nothing in this video should be considered financial or investment advice. This is purely educational content meant to inform you about crypto. So if that sounds good to you, hit those like and subscribe buttons, smash that notification bell, and let's get into it. Now, let's spill the beans on a powerful method to unlock more from your crypto holdings. It's borrowing. You provide crypto as collateral, receive a stablecoin loan in return, and still retain ownership of your original assets. But why even do that? Well, because it opens doors and lets you put idle holdings to work in 3 ways. First, you unlock liquidity without selling your bags. That gives you flexibility to move quickly in a fast-changing market. Second, because the loans aren't sales, many tax agencies consider them non-taxable. That means that you might avoid capital gains taxes, since you haven't actually sold the asset. That said, tax laws, they do vary by country, so it is imperative that you always consult a professional on this matter. Third is that you can immediately use the borrowed funds. With stablecoins now widely accepted in traditional finance, you could fund a major purchase, pay bills, or pursue a yield strategy of your choice. Just remember, interest accrues, and you still need to repay the principal. Now, while borrowing stablecoins like USDC is common, you're actually not limited to them. Some traders even borrow volatile coins to double down on their favorite assets. Risky, but valid for those with high risk tolerance. In today's tutorial, though, we'll be sticking with USDC for simplicity. Just keep in mind that stablecoins come with counterparty risk. But where do people actually borrow against their crypto? Well, there are 2 broad options, DeFi or CeFi. DeFi uses protocols like Aave and Kamino, where smart contracts handle your loan on-chain. There's no sign-up, and the rules are coded into the protocol, giving you full control and transparency. CeFi, or centralized finance, includes familiar exchanges like Binance and other platforms like Nexo. These custodial lenders hold your crypto, set the terms, and head out on-chain with your funds to generate a return. For the purpose of this video, we'll be looking at the DeFi option as they're the most accessible. Just make sure that using DeFi protocols is legal in your region. The last thing that you want to do is break any laws. Now, let's break down how borrowing works on-chain, using the leading lending protocol Aave as an example. Most DeFi lending platforms follow a similar model. In DeFi, loans are over-collateralized, meaning that you must deposit more value than you borrow. To manage this, protocols use something called loan-to-value, or LTV, which limits how much you could borrow based on your collateral. For example, if the LTV is 80% and you deposit $100 worth of ETH, the most you could borrow is $80 of USDC. That limit protects both you and the protocol from sudden price swings. Let's say that you play it safe. You deposit $100 of ETH into Aave and borrow just $20 of USDC. That gives you a healthy buffer, and you can now use that 20 USDC however you like. Meanwhile, you're earning interest on the ETH you deposited, since it's basically used by others borrowing ETH from the Aave protocol. Pretty neat. Now, as soon as you deposit your ETH, Aave calculates something called your health factor, which shows you how safe your position is. Think of it like a traffic light. Well above 1 is green. You're all good. In contrast, approaching 1 gets closer to risking liquidation. More on that later. Next, we have the liquidation threshold. It's not about how much you could borrow. It's the point where someone could step in and liquidate part of your loan to ensure the protocol remains solvent if your collateral drops too much in value. In our example, $100 of ETH backing a $20 USDC loan, you're in a safe position. ETH would need to drop significantly before you're at risk of liquidation. But the key rule is this: borrowers should be conservative unless they really know what they're doing. Now, let's look at the different liquidation scenarios. First is crypto volatility. If ETH goes into a free fall, which can happen, you could be liquidated if the dollar value of the ETH that you used as collateral falls too close to the USDC amount that you borrowed. The risk depends on the asset that you use and how wild their prices get. The antidote? Conservative borrowing, real-time monitoring, and keeping some backup funds ready to top off your collateral. Next up is smart contract risk. Even with top protocols like Aave, there's always smart contract risks. Bugs could freeze or drain a pool, or oracles could feed bad price data and trigger unfair liquidations. Finally, we have interest rates. Aave uses a variable interest rate, which rises when borrowing demand is high and falls when liquidity is ample. It could be as low as 2% or spike into double digits depending on market conditions. Always check the live rates before borrowing. We'll explore more on this later. And so that is the gist. Deposit substantially more than you borrow, watch your health factor, take note of interest rates, and you can unlock liquidity without selling your crypto. Done right, it's a really smart way to get more out of your assets. A pretty sweet deal. But if you're eager for the best deals in crypto, then you better check out the Coin Bureau deals page. That's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and cash back on deposits of up to 75% on crypto exchanges. Now, these deals won't be around for long, so take advantage of them ASAP using the link down below or the QR code on the screen. Now, with the theory behind us, let's get hands-on with some crypto borrowing, starting with Aave on Arbitrum. Step 1, head to Aave in our web browser. We'll leave a link down below in the description if you need it. Then go ahead and connect a wallet in the top right corner. Click Connect Wallet and pick MetaMask or your preferred alternative. Go ahead to check and approve the prompt from your wallet. And also, just a heads up, this will be a recurring thing whenever interacting with the protocol. Just take a second to check the transaction and hit approve when you're satisfied that nothing is amiss. Now, with the wallet connected, Aave switches to the dashboard view. By default, it will be set to Ethereum mainnet or core instance, but you could switch to your preferred network. Today, we're using Arbitrum by clicking the drop-down menu, but the process from here on out is almost exactly the same no matter what network that you choose. So let's supply some collateral. In the Assets to Supply section, click Supply next to your ETH balance and type in the amount. We're doing $100 worth for today's tutorial. The panel shows what interest you earn for supplying ETH to Aave's lending protocol, denoted as Supply APY, 2.05% at the time of making this video, as you can see. Your wallet will ask for confirmation, and once that's done, we see our balance of submitted deposits in the Your Supplies section of the dashboard. That means that we can now head to borrow some USDC. Simply head to Markets, as you'll see in the top left corner of the website. Once there, we click on the USDC coins section. Now let's borrow some USDC. Here we click the Borrow button. You may notice that we could borrow up to around $80 worth of USDC based on our $100 worth of ETH collateral. That's due to the loan-to-value limits that we touched on earlier, 80% for this pool in particular. Now we decide how much to borrow. Let's be conservative and go with $20 today. You'll see the box gives us a health factor of 4.22, denoted with a green color. That high health factor means our borrowing activity is relatively low risk. The closer we get to the maximum loan of $80, the lower our health factor is and the more that we are at risk of liquidation. When you're happy with your terms, ideally with a beefy green health factor, simply hit Borrow USDC. Your wallet will ask for one more signature, and if all looks good, approve it and you're now officially borrowed against your crypto. From there, we find the 20 USDC that we just borrowed in the Your Borrows section on the right-hand side. There, you'll also notice an interest rate of 5.4% APY, or annual percentage yield, is applied to this loan. It's important to keep this in mind. We're responsible for paying that interest, and since rates are variable, As we discussed earlier, they could change over time. So, whenever we borrow, we must make sure that we're prepared to manage the loan. Note that there is no monthly or even weekly deadline to pay this interest. It just slowly increases the size of your loan. So, you need to watch that carefully. Now, all that was nice and simple. However, loan maintenance is where most beginners slip up. So, let's walk through the essentials on that. Toward the top left of the page, you'll see a breakdown of the most important information about your account with Aave Markets. That includes your net worth on Aave, or the balance of your lending and borrowing to and from the protocol, the net interest you're earning or paying, depending on your positions, and the health factor of your borrowings. This is what we need to be monitoring closely, as it helps us plan our repayments in a manner that we can manage. Now, suppose ETH dumps overnight and your health factor slides below 2. Remember, the key to avoid liquidation is to not let that number drop below 1. So, to avoid that, we have two choices: repay part of the loan or add more collateral. Repay is easiest. In the Your Borrow section, click the button to repay. From there, you could choose to repay as much USDC as you prefer in order to boost your health factor. For the sake of this example, repaying $10, which is half of our $20 loan, would double the health factor from its current level, from 4.21 to 8.42. Note that your wallet may ask you to approve USDC for spending. If you have not done so already, simply approve that first when your wallet prompts you, and you'll be free to complete the repayment after that. Similarly, if we'd rather keep the loan and just buffer collateral, we head back to the Assets to Supply section and deposit more ETH, and enable it as collateral exactly the way you did it at the start. Finally, if we're ready to close the position for good, we hit Repay as we did before, and simply repay the loan in full. You'll notice here that we have to pay a fraction of a cent in interest in our example, a total of $20.000071, as we are already due to repay some interest. Borrowing does indeed come at a cost. After that, you have two options. You could leave that ETH in Aave if you wish to continue earning interest from others who are borrowing from the protocol, or you could withdraw your ETH. If you wish to withdraw, simply click the Withdraw button in the Your Supplies section and withdraw your ETH from there. Congratulations, the loan is history, and your collateral is back in your wallet. That entire journey took maybe 5 minutes. We borrowed stablecoins, spent none of our ETH, and kept risk measurable through that health factor bar. Not a bad system, DeFi. Now, while Ethereum and its associated Layer 2s hold the lion's share of capital in DeFi, Solana has solidified its place in the market this cycle. So let's have a look at how we could borrow against our crypto on one of Solana's leading money markets, Kamino. First, head to Kamino's website. The link is in the description below. Just like with Aave, start off with connecting your preferred wallet. For this tutorial, we'll be using Phantom Wallet, the market's favorite wallet for Solana. Simply navigate to the Markets tab up top, where you'll find Sol on top of the list of main markets. You may see Maple Markets listed above this, and that's a good option for those assets, but we'll be focusing on depositing Sol today. We click Supply next to Sol in the main markets, and the ball is rolling. We then decide how much that we want to deposit. Let's keep numbers simple and park $100 worth of Sol as we did with ETH on Aave. You'll notice that we're earning 5.66% interest on our Sol deposit in comparison to our 2.05% for supplying ETH in our Aave example. That's something to consider. Shopping around for rates across assets and markets is worthwhile. Anyway, hit the deposit button, approve the wallet signature, and that's that. You'll notice that Kamino, similar to Aave, gives you a breakdown of your wallet's financial standing with the protocol, just with some slightly different notations or wordings. A more detailed dashboard is found just below that, but we'll show you that after we borrowed our USDC. Now, time to borrow some stablecoins against our Sol. Sticking with the main markets, we could scroll to USDC and click that Borrow button. Then choose your loan amount. Again, let's go for $20 of USDC. You'll notice that we could borrow a maximum of $73 here in comparison to the $80 max with ETH on Aave. We're happy with $20 for now though. So we hit borrow USDC and immediately the interface takes us to our updated and detailed dashboard. Here, similar to Aave, you have a detailed breakdown of all supplied assets, borrowed assets, and more market details. Now, what about loan upkeep? Kamino's dashboard is quite extensive, but for today's purposes, we're going to focus on the most important thing, the liquidation and risk analysis tab. That gives us a breakdown of our key loan stats. Having borrowed $20 against $100 worth of collateral, you'll see our loan to value sits at 20%, very conservative compared to the max around $73. There is no health factor metric as used by Aave, so you have to be a bit more hands-on in interpreting this data and managing the loan. But the principles stay the same. It's wise to be conservative and always make sure that you have a healthy loan-to-value ratio well below the maximum threshold for the market. Now, if we're being more aggressive with our borrowing and/or SOL was dumping in a tremendously violent fashion, we would have to maintain the value of the loan to avoid risking liquidation. In that scenario, our options are the same as before. We can either repay or add collateral. Only here, the notation is repay from wallet or repay with collateral. Simply click on the three dots next to the borrowed section in our market overview, where we could find our borrowed USDC, and choose to either repay from wallet or repay with collateral. We do this whenever we wish to adjust to a healthy loan-to-value ratio, and we're good to go. And when we're ready to exit the position entirely, we simply repay the remaining USDC in full by clicking on those three dots and hitting repay from wallet and repay our $20 of USDC, borrow in full, plus interest, of course, which is again negligible in this rapid fire case. Then, if we so wish, we could go ahead and withdraw our supplied SOL, provided we don't wish to leave it in with Kamino to earn interest. But with some juicy interest to be earned at times, it's often not a bad shout. Just be conscious of the risks that we discussed earlier. And that's it. You've now seen how to borrow against crypto using leading lending protocols on Ethereum and Solana. Centralized options exist too, but each path has its own risks, so keep that in mind. We focused on ETH or SOL today, but it doesn't stop there. A wide range of assets can be used in this way, including the biggest of all, BTC. Since native BTC can't be transferred across other blockchains, wrapped versions like Coinbase's CBBTC are used instead. These are tokens issued by custodians who hold actual BTC and mint a one-for-one backed asset on another chain. Both Aave and Kamino support robust lending markets for these wrapped tokens. Given BTC's status as the largest and least volatile crypto asset, it's a strong candidate for collateral when exploring crypto-backed borrowing. But at least for today, that is all the time that we have. Now, to recap, over-collateralized lending lets you unlock liquidity without selling your assets. Used wisely, it's a powerful way to get more out of your idle crypto. Now, if this demo helped, then be sure to subscribe to the channel so that you don't miss our next one. And if you enjoyed this video, check out our latest one right over here. Thank you for watching, and I'll see you in the next one. This is Lewis, over and out.